All Things Money with David Blain. A discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain, and for the next 30 minutes, we're going to explore some topics about investing and talk about some taxation today on the show. But before we get started, as always, I'll give you our phone number and contact information. You can reach us at 252-633-0107. Our email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. You can also visit us on the web, www.dlblain.com. There you'll find information about myself and my firm, what we do for our clients, as well as copies of the archives of this show. If you happen to miss a segment from today's show or you want to catch up on previous shows, log on to the web and download copies of the previous shows. We'd love to hear from you. We love to hear from our audience. You got great questions out there. Keep them coming. Send us questions that you'd like answered on the air. We'll talk about a few of those today. If there's a topic you'd like us to talk about, I don't want to sit here and listen to myself talk about what I want to hear. We want to talk about what you want to hear about. So contact us through one of those venues, and we'll be happy to address your topic or question. Today, we're going to talk about a couple of things. First, we had a question from a lot of people, frankly, about what's going on in the markets and QE2. I may get into the IRS and some taxes a little bit. At this time of year, towards the end of the year, if you're not thinking about taxes, most people think about taxes in April. Well, now is the time to be thinking about taxes. The end of the year, you should be doing your end of the year tax planning. By the time April rolls around, it's too late to do anything, so you want to be thinking about that. As I record this today, there's been a little skirmish over in Korea. We hope that that does not turn into anything big, as we've been putting out in our publications, written publications to our clients in client meetings, as well as on this show. We've been talking about the markets and how we felt like towards the end of the year we would have a downturn in the market to take off some of the excess optimism that had built in the market, but we were fully expecting an end of the year rally and on into the next year. And I always caveat, looking at the market and what we think is going to happen and positioning the clients with one comment is that you can't anticipate the unanticipated. And it's always the unanticipated events that take the markets in a direction that we were not looking for. And so let's hope that this Korean incident does not turn into anything more than what it already is. So without further ado, let's get into the bulk of today's show. The first question I'm going to deal with, several people have been talking about, it's been all over the media, is QE2. And what is QE2? It stands for quantitative easing number 2. And what is quantitative easing? A simple way to put it is they're printing money to increase the liquidity of the markets. The more complex answer is that they're buying Treasury bonds on the open market. The Federal Reserve, is buying Treasury bonds on the open market. And they're doing this in the hopes of driving interest rates down or keeping interest rates down. What they're trying to avoid is stoking a large amount of inflation. And so the simple question is that I get, can you tell us where you think we are in the market and specifically any trends that you see developing? Well, and frankly, what I worry about most is the Fed's activity. I'm not worried about the markets per se. I think that markets are reasonably well functioning and that we could return back to normal fairly soon if it wasn't for so much intervention. QE2 is the latest demonstration of this attempt to manipulate the markets. The Fed has spent the greater part of the last, 15 20 years or so manipulating the markets whenever they feel that the economy needs a kick. And I think it's somewhat acknowledged, at least the people that I learn from and study with, that the stimulus programs that the Fed embarks on do not actually do anything for the economy themselves. What they do is they help boost asset prices to create what's called the wealth effect. And the wealth effect, if the market goes up 50%, people feel richer and they feel more confident. And the academic world feels that they spend approximately 3% of that. So when the market went up 80% last year, that comes out to about 2.4% extra, 2 to 2.4% extra GDP. That's what we call the wealth effect. Is that by lowering interest rates, the Fed can encourage borrowing, they encourage speculating, they encourage investing in assets other than things that pay a very low rate of interest. And what that does, it raises markets, either the stock market, real estate market, commodities market, and as people feel wealthier, they tend to spend more money, somewhere between 2 and 3%. And so I feel like that is exactly what's happening. The reason this time you're not seeing such a big boost is the huge counter drag in the housing market, the utter destruction almost of the housing market. I think it probably would have been a little bit worse if it weren't for this, but the Fed, its results have not shown quite as good this time because of the housing market. And that's one thing that I think the Fed does know how to do. They do know how to stimulate the economy, or not the economy, but the markets, by lowering rates and in encouraging people to do speculative borrowing. Last week on the show, or a couple weeks ago, I talked a little bit about how it's been shown that the addition of debt in the long term does not do anything to increase the GDP of a country. And so all you're doing is you're getting an artificial boost in the short term. We think one of the problems with the Fed is when they go through this stimulus plans, whether it be QE2 or lowering interest rates, is then once the economy starts heating up, they sort of forget about it and they don't do anything to keep it in moderation, and so you have these bubbles. When we come back from the break, I'll talk a little bit about some of these bubbles that have occurred over the past 10, 15, 20 years, and what we think we need to do going into the future. So for All Things Money, my name is David Blain, and we'll be right back after a short break.